This is the Energy Talk Podcast.
Nela, good morning and welcome to the Energy Talk Podcast.
Good morning.
So it's a pleasure to have you here. I'm very excited about this conversation. I'm used to talking to startups in the early stages, but it's very rare to talk to a fund focused on climate tech in a relatively early stage and looking to scale up rapidly. So I'm very excited for this conversation.
Thank you so much.
Yeah. So the way we typically like to start, just a bit of a warm-up, is the story of how you got into the energy sector. I know for you, that's a bit more broad to climate and conservation. So what was that instance in your career that drew you into the climate space?
Thank you. And thank you so much for having me. I would say that it's a very long-winded, far back story, but I'll simplify it as much as possible in the interest of time. I went to the Obudu Mountains in 2013. It was an area that I'd visited a lot with my family growing up. And it was the first time. And so when I would visit when I was younger, there were baboons, there were different primate species, bird life that you'd see as soon as you get up to the mountains. And then when I went there in that year, there was nothing. It was the community was obviously doing really poorly. The ecosystem was dwindling. The community didn't even have much water left because they were chopping down the wood and that was degrading the forest. And so it was the first time I saw like a physical representation of what the climate crisis was doing. And fast forward many years later, it sort of has evolved into what I'm doing now with the fund and trying to support climate change in Africa and energy being such a huge part of that.
I think one thing that's always I find quite striking is people talk about climate change as a vague concept, and it's very difficult for them to tie it to something physical and real in their lives.
Yeah.
So when you had that experience, and between that time starting the conservation and starting the fund, was it a difficult thing actually communicating the effect on climate change and why it's important to specifically to deploy capital to address, or was it something that you found relatively easy?
No, it wasn't easy, because it wasn't sexy like it is now. I think now everyone is, sustainability, and there's sustainability in fashion, there's sustainability in film, like all like the cool industries have adopted it and it's beautiful and I'm happy because it makes it easier for me. But back then it was a very foreign concept. Like no one really understood why it matters. And there was, unfortunately, specific to Africa, and I think a lot of developing nations have the same experience, is that they feel as though the West went through this, different industrial phases where they were able to plunder their environments to get to where they are now. And so why should we not be able to do the same? And so when many moons ago, I would have these discussions with people, I was always met with that same feedback. Whereas obviously now the science is unrefutable, the data is there, the many, many years that people have put in are there. So it's harder to combat that. And more importantly, I think on like a social level, there's a consciousness that's arising that makes it easier to communicate why climate change matters. And again, I had that very stark experience. It's harder to see it in the cities and in the developed areas. You don't really like have that same experience. So I think people are also now having it, summers are getting hotter, rains are not coming. We're experiencing it here in Abuja. So it's something that you can't really refute as much anymore. So the conversation is much easier in terms of raising capital towards it.
And before we get into the capital side and the fund, there was your conservation work. So how did that develop over the years from that your initial experience to forming an organization around it that really driving real work on the ground, especially in the Obudu region? So what was that experience like for you?
It was extremely organic and I would say God-given. So in 2002, the organization was actually set up by my mother. And she was doing mostly education around environment in the region. And then it shut down. And so when I went back and I had that experience, I was like, oh no, we need to, this is an area that needs to be focused on. So I restarted the organization as a co-founder of it to the Obudu Conservation Center today. And from then till now, we've been able to do tremendous work in the community and the broader ecosystem of conservation, not just raising awareness, but also research that we've done in the region that hasn't been done in decades. We have been able to create a forest reserve. We have been able to create farmlands for the community, teach them about agroforestry, where you farm alongside the forest so you don't disrupt the natural flow of things. Rather, it's adding to the forest and the protection of it. And yeah, that's like a lot of the work that we've been able to do and support the conservation effort there.
Mm-hmm. So now let's get into the fund. So I want you to first give us a background. What is the fund? How big is it? And what are you looking to invest in?
Okay, let me do my pitch. Obudu Capital is a $20 million climate tech fund, and we invest in early stage startups in Africa, specifically in Nigeria, Ghana, Uganda, and Kenya. And those geographical regions were chosen for very specific reasons. I won't bore you with all of that, but it's also has to do with the distribution of the team. And so where we're actually on the ground and can offer the most help. As you know, startups at that stage need a lot of assistance. And we wanted to make sure that we were present to do that. It's also regions that we feel as though have been greatly impacted by the climate crisis. And we have chosen our specific verticals based on what we feel is, again, most impacted by the climate crisis. So I would say we're a generalist climate tech fund, but within that, we're trying to focus on climate finance, energy being a huge component of what we're doing, health and well-being. We're looking at sustainable resource use. So that is agriculture technology as well as waste management. And then finally looking at sustainable infrastructure, so mobility, et cetera. You wrote a wonderful Medium article about that.
Yeah.
So I've shared that with at least 10 people so far.
Thank you. Oh, wow. And something that I always find quite fascinating is you made a comment earlier that right now climate is sexy. It's something that people want to go into. It's something that's attracting a lot of capital. Last year, Kenya alone raised a lot of money going into the climate tech sector as their leading vertical. And we're seeing that trend even globally outside of the continent.
Yeah.
But when we come back to the local level of actually raising a fund, selling that story to investors that are looking for return on their invested capital. What is that dynamic? Like, what were those early conversations when you're trying to sell the climate tech story in Africa?
So the early dynamics was why, especially in Nigeria. As you rightly said, Kenya, for a plethora of reasons, but Kenya has been a global, well, at least a Pan-African leader in the climate tech sector. Kenya, South Africa, some of the North African countries have done a phenomenal job in terms of their regulations, integrations of ecosystems, et cetera. So looking at the Nigerian angle, and maybe Ghana as well, and less so East Africa, it was a much more challenging conversation because this is the hub of fintech. So the trends would be like, oh, but if you're speaking to a Nigerian investor or a Ghanaian investor, they would view it more like, oh, but you're in the home of fintech. Why wouldn't you just follow that trend? But the truth is that Nigeria is one of Africa's greatest economy, but it's also one of Africa's greatest pollutants. And we are severely impacted from the climate change crisis. In the geographies we've chosen, a lot of them fall into the statistic of 17 out of the 20 most affected countries of climate change are in Africa. Nigeria is definitely one of them. Uganda, Ghana as well. And so the conversations were initially hard when we started off. But I think now, the president made an announcement last month that they're going to be doing a lot of work towards carbon credits and getting the regulations in place to make sure that that's able to exist here. And that was phenomenal news to me. But in Kenya, if you juxtapose that, it's very much like, oh, okay, why haven't you already started this? And it's very needed. So it depends on where you are on the continent or who you're talking to. South Africa as well, it's very, very welcomed. And unfortunately or fortunately, I found that raising capital is actually easier out of the continent than it is in the continent. And sometimes those trends have to be set outside to be adopted inside. That's just a mindset shift that needs to take place. And it's not the end of the world, but as long as it's happening, I'm a happy camper.
And something else, the listeners of the podcast will be sick of me saying this at this point. Part of the external drivers, especially the Nigerian market, is how the prices of petroleum products have been doing, specifically petrol, diesel, like just increasing astronomically in the last 4 years. Like I think it's like maybe 4x increase during that time. So that has driven a lot of demand for solar, and we've seen a lot of companies pop up. And that also presents an interesting dynamic where a lot of the existing, specifically climate tech companies, are kind of like scaling up quite rapidly to address that. And they run into that obvious need for capital. right? So in terms of just moving away from the fundraising side, the business models that you're seeing in the verticals that you're pursuing, how have you seen them basically play out in the VC model? Because I'm sure that not every kind of climate tech business, especially since they're so infrastructure heavy, might fit into what the traditional VC wants to see. You made a comment about fintech earlier because it's very asset light, it's probably very high profit margins, and they don't have to deal with as many of the assets-based business models that the climate tech business have to deal with. So apart from selling the climate tech story, selling the business models to your limited partners, to your potential investors, how has that dynamic been?
So I think I'll first circle back to what you initially said with the price of fuel going up. When Nigeria started that subsidy in 2023, it was definitely a shock to everyone's system, individually, business level. Everyone was taken aback. And that had tremendous ripple effects. But the benefit and the net positive, as you said, was that it increased the need for, sustainable energy alternatives. And so then it led to a lot of startups, companies, really ramping up operations and making sure that they could meet the demand that was now here. So that's like definitely the positive. But then looking at the business model side of things, you said all the nice, sexy words that VCs like to hear: asset light, profit margin. We love it. But it's just not the case for climate technology all the time. And so it's finding limited partners who understand that. And it doesn't mean that they're less profitable. It just means that you have to be willing to adopt patient capital. You have to be willing to adopt like different financing models. So we use a blended finance approach. Yes, there are equity investments that we'll make, but also convertible notes. We're looking at, revenue-based financing, debt, and just different models to fit the particular business. We also create financial models behind every company we're looking to invest in. So it's not just like, oh, this is a cool idea, let's throw money at it. But it's like, will this actually impact the fund in the long term? Additionally, we have adopted a 10+3 model fund life cycle, just to give us and our limited partners more time for the companies to do those returns that we expect them to do. And that's where the patient capital comes into play. Because I think a lot of the things that are assumptions that come with VC is that it's easy money, it's quick, it's like it's here, it's now. And that thinking has gotten a lot of startups into trouble. It's gotten a lot of VCs into trouble, and limited partners ultimately in the most trouble. And understanding the weight and the commitment of the capital that you're receiving and trusted the fiduciary duty behind that is extremely important when it comes to investing. And so that's why we take that approach into looking at these different financing options, or instruments rather, to invest in these companies to make sure that they are well equipped. Because also, I'm sure your audience already knows this, but in VC, most of the time they look at equity investments. Like, we'll give you $500,000 for 10% of your company and then leave it at that. We'll 10x and we'll be on our way. But that might actually be a negative to the founder. It might not actually be beneficial to a founder that would grow better from debt. And then that will in turn impact you. So it's looking at what's best for the founder, what's best for the VC, ultimately what's best for the limited partners, and working backwards from there.
And perhaps maybe the audience isn't as familiar with it. The typical life cycle for a VC fund in Africa is around like 7 years. So I guess that's where it runs into a lot of trouble, because for a typical VC that's looking at like operating in the African continent, they're seeing all the juicy fintech exits, and you come to them and say that, oh, I have $5 million in physical assets and I'm looking to finance them to my end users. They look at you, they just go, what on earth are you talking about and why? I would not give you money. So which is why there's been a lot of demand for funds like yours that understand the context of the business models and are willing to back them with appropriate capital.
Exactly.
But one thing that I do see that pops up a lot is the climate space in general is very impact driven. So as somebody who has been in this space for a very long time, I understand that like there's a lot of concessional capital available. They like to hear things about it, about impact, about like the end users, about all these things. But once you get to the other side and looking at the private capital, all they really care about, when all is said and done, is how much money will I make.
Okay.
So really, really bridging that gap and communicating value in terms of impact/returns has always been something I find particularly tricky for funds. How have you navigated this?
So we definitely would like fall under the umbrella of like an impact fund, but it's also depending on who you're talking to. Like sometimes you're talking to people who are purely commercial and just want to have their money, and that's fine. I want money too.
Yeah.
But then some people care more about the story and more about like the impact that it will have and it will drive. So it's one, like knowing your audience and who you're talking to. And even, I mean, all businesses do have impact. Let's also say that, but just some are more impact driven than others. So even if you're looking at Flutterwave, like one of the most commercial, fintech companies come out of the continent, there's been a lot of positive impact that they've had in terms of accessibility to finance, etc. On the climate side, when we're navigating like those waters of like impact versus profit, one of like the greatest myths is that if you're like an impact fund, you're not profitable. That's not true. Actually, the more focused a fund is, the higher the returns tend to be, because you're dealing with specialists as opposed to like someone who's completely like generalized, just throwing eggs at a basket and hoping something gets in. The second is that we track a number of metrics, but our key metrics are really the CO2 emissions. We're looking at job creation. We're looking at women empowerment. And those are because we're looking at the populations. One, the populations are most impacted by climate change, which tend to be women and children. Then looking at job creation, of course, like employment in Africa is such a huge issue. And then finally, CO2 emissions, which is just such a central need when it comes to climate and looking at, energy or just the reduction of the impact that we're having on the continent. The challenge that we've seen is not just specific to us, but I think a lot of funds have this issue, is that because everything is so new and everything is, evolving every day, those metrics, you can say, we're tying ourselves to 2X challenge or, the BII metrics, but still like this level of generalization that happens and the evolution is still in play. So sometimes like the metrics that you're looking at, perhaps an LP might not be looking at those metrics, or the way or the methodology in which you're collecting your metrics might be different from the way someone else is collecting their metrics. And I hope, my prayer is like within the next 10 years, that will all become centralized and it'll be easier to tell that story, because it really does play into like how you tell the story when everything is sort of all over the place.
And one other thing that's pretty interesting is you mentioned the term blended finance. Obviously, you're going to be pursuing capital because it's available. I mean, why not? From concessional sources, DFIs, and maybe more impact-driven LPs. The good thing is we've seen a lot of influx from those kind of players bringing in real capital into the sector. And that gives funds like yours or the climate tech funds the option to really get creative. The question is, when you look at structuring your fund with the idea of the kind of businesses you want to back, has that been something that has been easy to translate? So your theory on paper, looking into the market and looking at your deal flow, has that been reflective, or has there been any need to kind of adjust your expectations there?
It's been extremely reflective. Like every single week, our head of investments and I, Nabira Nambuze, one of the most intelligent people I've ever met. She's phenomenal. But every single week, we're going through how we're looking at investments, what instruments. I mean, there are over 20 different instruments. I think people are just like, oh, equity, debt. But like there are over 20 different instruments that you can use, and what makes sense for not just the verticals that we're investing in, but also for the context of the ecosystem in Africa. And unfortunately, I think a lot of companies, so our pre-seed is not the same as a pre-seed in the United States. Our seed is not the same as a seed in the United States. You know this very well.
You can't come with an idea and raise $1 million.
No, you can't come with like a dream on a piece of paper and be like, I raised 20 million from Sequoia yesterday to go try this out. It has to be really hard. It has to be stress tested. And that's something that we actually just had this discussion yesterday, where we're looking at how we're going to stress test our due diligence process and make sure it's as thorough as possible. Because again, unfortunately, Africa, we don't have margins for error anymore. I know you were in the ecosystem when Africa is rising. Have we risen or have we not risen? I don't know. So I think the global market is looking at us like,
where are we
with this rise? So I think that it has been extremely reflective in the type of companies we're looking at, especially when it comes to climate finance, because it's so broad, it's so new. It's easier to look at climate finance in the context of Kenya and Ghana as well. They are They have the regulations in place. Nigeria, we're still, stepping up to the plate in that way. But there are a lot of things that if you don't have those foundations, it's hard to build a company on top of them. It doesn't matter how hard you push.
Yeah.
Right. So I think that has really impacted the way we're looking at our deals, how we're looking at the type of support we can offer, how we have structured the percentage of which we're going to place each deal in, also the verticals we're investing in, how we're investing in them. A lot of it sits on the back of regulations, the ecosystem, the global attention that it's receiving as well.
And I think something that's very striking, and as someone who has been in the climate tech space, worked with startups that are very asset heavy, I lean very strongly that investors need to embrace that the asset heavy nature of climate tech businesses is a feature, not a bug. It's not going away. They need to embrace it. But I can also say that those kind of businesses are very hard because it's very hard to run. And back to the stress testing, it's really important because there's so many ways that a business like that could fail, whether it's a lack of working capital, regulation just killing a project, or delays, logistic supports because most of the goods are imported. All these things play a very large role, and it's extremely hard as well. But to that fact, we've also seen a lot of recent fundraisers from climate tech businesses. Yes. There have been some really exciting announcements in the e-mobility space, in the energy space, in the agritech space as well. Has that made it easier to sell when you can be able to point and say, oh, but look at this Series B company who just raised like X million. Look at this like pre-seed company that just raised like 3 million. Do those kind of headlines help as well?
Of course, like every success story is just validating what we already know about the continent. I mean, again, looking at the example you gave about agriculture technology, we do have the most arable land in the world.
Yeah.
There's no reason why we shouldn't be the global leader in that space. But again, having these underlying biases that a lot of people have towards hardware-heavy businesses, and a lot of them do incorporate like software or SaaS, but farming is farming. Energy is energy. It is what it is. So unless I don't know, there's no way around it. So to your point, it's a feature, not a bug. And it's just drumming that into the psychology of people. So every time you see a success story, even if it's the smaller ones where you see, Uwana was accepted into Village Capital, or like there's a mobility company in Rwanda that's raised a significant amount of money. It's just validating that idea. And again, unfortunately, I hate that so much of it is tied to the outside market, but that external validation does go a long way within our continent, and seeing that there's a global appetite does really do wonders for fundraising. And another thing I really want to encourage investors to steer away from is thinking you're solving a problem for Africa, in Africa, like that whole by Africans, for Africans in Africa. We're solving global issues. Everyone needs to eat. Everyone needs to power their homes. Everyone needs to get to work. Everyone needs healthcare. So we're solving global issues, and not limiting ourselves to this boundary here is something that we deeply encourage our founders not to do, not to think in that way, because that limiting belief ultimately has such strong ripple effects. And I spoke to another VC last week, and he had a similar feedback when I asked him what's the big difference between a Series A company, because he'd worked in the Bay Area. I was like, what do you see as the big difference between a Series A company in the States and a Series A company in Africa? And why is it so hard for us to make those jumps? And he just said it's the mindset, because they're so limited in, not so limited, but they can be limited in what they're building for. And so they start building for a very specific market when they could be building for a global market. Again, this isn't applicable to every single venture, but it's still having this expansive view of what you're actually doing and how much the world needs it. So I want to take a step away from the investors and the fundraising side and go to the startup side for now. I have a theory that as soon as you put capital next to your name or next to your organization, you're going to get a ton of inbounds from founders who are really eager to raise money as soon as possible. So there's this perception that deal flow in theory shouldn't be easy, shouldn't be difficult rather. But then it comes to how to get across to high quality companies with the right teams at the right stage. And like you said, there's a higher burden of proof, even for pre-seed companies. It really does need to be stress tested because there's so many things that can kill you, quite frankly. And
One thing that I found very interesting and maybe a bit controversial is I think we need a lot more shameless capitalists in the climate tech space.
Interesting. Tell me more.
Where we can genuinely have a company just come out and say that we are going to make a ton of money and we're going to do it across this timeline.
Yeah.
And you should give us money to do that.
Mhm.
And I feel like a lot of the founders in the climate tech space sometimes oversell the climate story.
Mhm.
I give an example, right?
Okay.
I used to work for a company that electrified off-grid communities. And when we would make a pitch to the communities on why they should sign up, it was a waste of time to sell them that, climate change is this, it would affect your lives and like whatever, rivers will dry up, it become more difficult to get good harvest.
Mhm.
You need to sell them on the actual productive things. Like you can charge your phones for cheaper. You don't need to buy diesel at an inflated cost because you live in an off-grid community. This is a cheaper way for you to do X, Y, Z. It's going to make your life better. Like that is what actually sells them.
Yeah.
And I feel like we need to lean more into those things because a lot of the businesses, like you said, are actually deploying ways to make either it is the energy delivery better or the agriculture chain more valuable and more valuable to the communities that actually like producing all of that crops. And that's something that I feel is missing sometimes when you talk to founders. I don't know if this reflected what you're seeing, but I genuinely think that we need more shameless capitalists here.
I agree. Long and short, I agree. I think that to your point, a lot of people think like you have to have this like really grandiose, like, I'm going to save the world.
Yeah.
But, I'm just going to let you live cheaper.
Mm-hmm.
Got me. That's it.
Exactly.
That's it. And you have to have, and this isn't just specific to Africa. I think this is like human beings in general. You have to like know who's in front of you and know how to like focus on the product that you're selling. Because the truth of if it's not going to, even like on the fund side, the startup side, it's all the same. If it's not going to greatly impact the person in front of you, why should they care?
Mm-hmm.
And so if you're able to like put yourself in the mind of the person you're talking to and like, what does this person want me to feel? What does this person want to get out of this conversation? And then tailor it to that, then you can start like really driving forward.
Yeah.
Because otherwise you're sort of, I think, and this is something I've experienced a lot, is that because they have these like huge pitches, it's sometimes just difficult to understand. And I'm not saying I'm not Elon Musk here. I wish I was in some regard. So I'm not him, but I can understand like simple things. But sometimes it's just so complex that it's like, you've lost me before you've even gone anywhere. So how are you going to actually sell this to your customers?
Yeah. And like you said before, like if we have headlines of $1 billion climate tech exits, it wouldn't hurt anybody. Right?
It wouldn't.
Yeah. Well, the upside is there are a lot of founders in this space. So when you speak to prospective companies looking to invest in, what is the feedback from the founders that are looking to fundraise right now that you've interacted with so far?
So they're really looking for not just an investor, they're looking for a partner. And I think that's where a lot of VC in Africa went wrong, is that and it's not to anyone's fault. I mean, you're trying to run a business, you're trying to make returns. There's a lot of things that goes into running a VC outside of the founders. But a lot of the times the founders are forgotten and they just focus on their shiny new toys, like the ones who are, the flutterways of your portfolio, right?
Yeah.
And you're trying to see how you can get those across the line. But founders are noticing that. And I think there's also been a shift of power dynamics between the founder and the funder. So even though, yes, if you put capital in front of your name, you'll get a lot of inbound. But like the really good deals, they're looking at like, how are you going to serve me?
Yeah.
And like, what am I going to get from this relationship outside of just money?
Yeah.
And because like Africa is in such a sensitive place right now, people aren't playing around as they used to. It wasn't just like, okay, here you go and, be on your way. Serious founders want serious support. And that is a lot of the feedback that we're getting. So sometimes like after we've asked our initial call due diligence questions, the table flips and it becomes, okay, let's interview you guys.
Yeah.
We want you on our cap table. Like, what are you going to bring to the table? Like who's in your network? Who do you know? Like, what's your return like? Like, what's your track record? So, and I think that's really good and really positive because it means that as a whole, the ecosystem isn't playing anymore.
Yeah.
And I think specifically in at least like the founders that we've really taken the time to speak with, like they're incredibly serious people who understand what they're doing, like beside like the impact, but they understand like the weight of the investment and having that return come back. So to your question, like what are we seeing with founders in that relationship? It's that one, they are being extremely discerning of what type of capital they take. So as much as like we're also looking at blended finance, I think a lot of founders are also exploring like different, financing sources. A lot of founders also know now, like when should I take a grant and when should I take, commercial capital? They are also understanding like the importance of team dynamics and who you work with. And even though, you have $1 million to give me, like what does that long-term relationship look like for me?
Yeah.
And so I think it's so nice to see founders becoming more savvy and understanding the good and bad of VC and how it can be predatory in nature. You hear these crazy stories of like founders, selling their company for $50 million, $100 million and walking away with like $2 million because they didn't understand how to set it up from the get-go.
Yeah.
And I think that to see in Africa, a country, and VC in Africa is about 10 years plus, 20 years. But to see that they are now catching up to, I guess, the edges of the industry makes me really happy. And the conversations are much richer.
Yeah.
Yeah.
That's indeed a really good milestone, because one thing that's also pretty exciting is because of the growth that climate tech has had and the perception changing very rapidly in the last 10 years, a lot of really great founders are coming into the space. A lot of really experienced operators are coming in and looking to start something. So I completely understand. Like you have a lot of really great companies and they basically have a very clear idea of what they want to build. And those for me, as someone who's worked in some of those businesses, it's one of the best places to be at this point. And
so just really quickly to that point, like it made me smile because yes, I love like this 16-year-old boy genius. Always a boy genius as well. I love them so much. But I think having like mature founders and people who understand like they get the industry inside and out. Like it makes my heart sing seeing more of that. It's not just like, oh, I have this, daredevil idea. Yeah, you can go to California.
There's plenty of money there, so they'll be fine anyway.
Yeah.
So you mentioned the ecosystem, and one of the other beauties of the climate tech space is how interconnected the ecosystem is, largely due to necessity.
Yeah.
It's very difficult for one VC or for one DFI or for any kind of capital provider to operate in isolation. So there's a lot of need for collaboration, especially for deal flows. If you come in early, you need to help them set up pathways to raise possible future debt for the equity. And it's a very interconnected space. So when it comes to approaching the ecosystem and partnerships, how has that been earlier on and what are you seeing right now?
So myself and my team, like we've been really fortunate that we've worked in the investment landscape for everyone at least a decade plus. And we've built relationships over the years. And so Obudu Capital was initially set up by a family office legacy. And the beauty in that is that when it comes to these earlier stage founders, a lot of the capital that's flowing will have to come from like the family office space, like the family office into the fund and then the fund into the founders, because it's still new and there needs to be a level of de-risking for, the pension funds, et cetera, to take that bet. And what we found is that when you're building the ecosystem, again, like ecosystem building is thrown around a lot, but it's really just relationship building and the relationships that you've been able to garner over the years. And we have been very intentional, like all of us, with our relationships and making sure that, we're able to key in the people who we think will be useful for the founders. And that goes down to like academia, which is like a huge thing that's like greatly overlooked, especially in climate technology, because, now, AI is sexy, so everyone is AI. But we're missing a lot of data. Where are you going to get the data? The academics. And so making sure that we're able to bridge those very specific gaps, because there are so many institutions doing like phenomenal research, like deep research, whether it's in agriculture, energy, just the climate in general, and understanding that. And you have these builders and these entrepreneurs who, again, are also phenomenal within their own rights, but there isn't that communication that's ongoing. And you have companies such as Ishango AI who are able to bridge those gaps, where they're able to look at like the actual work that's coming out of the institutions, look at what the founders are doing, and see how they can work closely together to achieve their ultimate aim. So I think that's a big one. I know like there are a lot of other ecosystem players, like regulators, as you said, the DFIs, like et cetera. But I think academia is one that's very much overlooked because like it's a world of knowledge, especially now where knowledge is king. We're in the information age, and a lot of these. You have like a PhD on your phone. So like a lot of information that you need doesn't necessarily have to come from you, but like who's mining that information? Like that's who you need to know.
Yeah. That's a very interesting point. And just to stay on the partnerships point a bit, you made a very true statement earlier that a lot of the capital for climate tech does come from outside of the continent. That does present an interesting dynamic, should I put it? So from my experience, when you're running climate tech projects, specifically energy projects, renewable energy projects, and you have, let's say, grant support from a foreign entity, usually they have like an operating manual that kind of dictates what projects can do and all these things. And sometimes if it's done incorrectly, it can really distort what would normally be a purely capitalist-driven business model, and it can incentivize some businesses, companies, projects that may not be viable long-term, but it meets like the stated like printed cause or output of that particular program. That can be an issue, but for VC, the approach is a bit different because you basically have a different strategy to go into companies. But are you seeing a similar problem where outside capital can, in some sense, distort the local markets, especially for climate tech, since it's still so early as well?
Yes, like exactly what you said. I have definitely seen that because there's some companies that are purely just impact driven and should be reliant on grant capital, almost be an NGO in the way that they operate. And to your point, grant capital, because they're just looking at the impact, it can sometimes distort the work that the founder is trying to do because your hands are tied and then you can then fall into this cycle. So I've definitely seen companies that were initially profit driven but have impact, take grant capital and then shifted their entire operating model and now can only rely on grant capital. And so when you're in that position, like you'd have to initially almost like put a stop or have like really hard conversations with the capital provider to say either we can't take this capital and start again, or like what is the leniency, which is why like unrestricted grant funding is really important, or like different types of grant funding. I think now people are looking into grant funding that can be recouped as an investment at a later stage just to de-risk the idea. And I think international markets, and it's also coming home as well, are looking at different ways to innovate that type of financing because this problem is really real and it becomes like a bottomless pit in a way. Like, so yes, you're getting the impact you want, but the company isn't ultimately able to innovate or be profitable in a way that it would need to grow. So like, what is the actual outcome that you want for this capital? And I think a lot of funders need to have those conversations with themselves and stop operating in those, I know people say silos so much, but operating in those silos, because like people who do grant or foundational impact, like they're just over here and the DFIs, they're over here and their way of doing things aren't necessarily perfect. And then you have, the commercial capital that sometimes is predatory by nature, but like there's a balance that can definitely exist across board. And founders are starting to realize it. And I think a lot of founders have been burned, especially in the energy space. We've seen like at least 3 deals like that where like it's great, but if you don't get the grant capital, it's not like they can't survive without that grant capital.
Yeah. And I'm realizing now that I'm probably coming across as a cold-blooded capitalist on this podcast, but that's fine. But the point is, anyway, the capital is there. And when you're structuring your fund, obviously these are conversations that you've had to have with your partners, with all the LPs. And it's something that there's no perfect fix, but it's something that, how do you lean towards? Is it something that's just necessary for now? Or do you think it's something that needs to be phased out gradually as the space matures?
I think you can have it all. Actually, I think they just need to really innovate how they're looking at grant capital. So I'll give an example. I know FSD has an instrument where they do give grant capital, but then it converts to equity at a certain point. So it's redeemable grant capital. And that is something I'm seeing more of. Or some foundations, what they do is that if they're able to get a co-investor, they will give grant capital alongside that as long as, someone has stress tested your idea. And that allows them to give the unrestricted grant capital towards the innovation. And so I think it's more so of, not necessarily doing away with it entirely, because those types of capital that are de-risking, that are, first movers, I think it's definitely necessary, especially in the context of, Africa and many developing economies. But I think it just needs to be looked at in a different way that is more sustainable for both like the investor and the founder. Because it could be a win-win. I don't see why you just have to throw your money away.
Very good point. And also on the flip side of partnerships, there's also the role of governments and regulation specifically. And this can get very interesting because unlike fintechs, where largely the rule books are still being written, when you come to that, the climate tech spaces is mostly legacy industries that are very infrastructure heavy. They already have some rules, but then you're trying to basically to introduce new ways of doing business, new business models, new technology and all these things. How has the relationship or the conversation I've had with regulators, especially when you point up the newer spaces like the carbon markets, right? So those are entirely new. So what have your relationship with regulators been so far, and how do you see that relationship like shaping going forward?
It's good in some geographies, could be better in others. So Ghana has great regulation. Kenya has great regulation, even Uganda as well. In Nigeria, we definitely are part of the Paris Agreement, which is a beautiful step forward. And that, I don't know, the Paris Agreement is an agreement that was signed in 2015, and it allows for the reduction of carbon emissions globally, and also their, financing perks for developing nations to support their climate adaptation. And so a lot of African countries are part of that agreement, but then there has to be, policies that are put in place on the ground for these innovations to build up on top of. So to your point, when it comes to carbon credits, there definitely are a lot of great companies that we looked at, but because the regulations weren't fit at the time, we had to pass. And so the conversations that we're having with regulators are two-pronged in that, one, they know it's needed, and it's definitely always on the agenda. But because of how a lot of political systems are set up in Africa, it's not always top of mind. So it takes them a bit longer to get there. We will get there. We have to get there. But it just takes us a bit longer. But if you have countries that so Ghana has moved with that at the forefront, and they've had great leadership that has, put that at the forefront of their agenda. And incredible things have happened. And even there's a mobility company, I'm sure in Ghana, that has been able to benefit from that. And actually, we spoke to one of the first companies, I think pre-seed companies, that was able to become a gold standard. And that's just an account. That's just, anyway, it's one of you have Click, you have Gold Standard, you have Vera, and they've been able to be verified by these international bodies to get carbon credits. And it's incredibly hard. So whether or not you have the regulations, it's really, really difficult for companies to be verified. So when you're speaking with policymakers, it's just a challenging because they know there's nothing, they know. They know, but it's just, is it top of the agenda now? Probably not.
Yeah. So I guess for the most part, it's mostly just pushing back a lot of the uncertainties, regulatory uncertainties included as well. So I know that Obudu Capital is still in the process of fundraising.
Yes.
When you speak to LPs that are potentially on the fence, I guess there's an opportunity as well, because I'm sure some of them will be listening. What is the one thing that you want them to go back with when they're thinking about investing in climate tech in Africa?
That is a really good question. I would say that the one thing that I would love them to go back with in looking at climate tech investing in Africa specifically is that the returns are there. It's not like a unproven model, which I think a lot of people have this preconceived notion that it's we're trying it out. It's been done. And more importantly, it's actually been done without VCs, which makes it even that much more certain. And so you're not, investing in a new AI product. You're not investing in a new fintech product. You're investing in something that almost has that legacy component that has been durable for many, many years. A lot of the companies you've been a part of had to overcome tremendous challenges to get to where they are today. And that's what we're looking to back. So even though it's not as sexy, it's actually even more sure in my eyes. So that's one of the big messages I'd like to take away.
Very well said. And the question we usually like to end our episodes on, we send this in advance so you could have a think through, is with the work you're doing, very impact driven, and there's a lot of capital being at stake also in that conversation. The LP relationships, the government, ecosystem, startups. With all this in mind, how do you define failure in the work that Obudu Capital is doing?
You know what's funny? I know you sent this to me and I'm still thinking about it. I'll just give my answer on the fly.
Yeah.
I don't, because I kept going back to this and so I'm just going to say it. I don't necessarily believe in failure. I believe in redirection. And I think when we started out, our funding was actually completely different. And our approach was different. We were looking at pure equity, but it just wasn't fit for the market. And so every time we've had a redirection or a roadblock or perceived failure, it was more so how do we come together as a team and bring our collective experiences together to redirect this into something that will work. And something not just that will work for us, but something that the ecosystem actually needs. And so that's how I would answer that question. I don't believe in failure.
Very, very well said. So for founders that are listening that want to get in touch, what's the best way for them to reach out and pitch their ideas?
There are many ways. So one, you can email me directly at nde@obuducapital.com. You can email investments@obuducapital.com. You can also apply through our website. You can send me a LinkedIn message. I'm now active there. Those are the ways you can reach out to apply. And we're just so excited about this. I've been investing for a while, done angel check. But being able to marry my love for the planet and also for capital together has been just the most rewarding experience.
Very well said. And this has been a great interview. Thanks, Nela, for joining. It's been a pleasure.
Thank you. Thank you.
This is the Energy Talk Podcast.